You're listening to The Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koch, president and portfolio manager at Libertas Wealth Management Group at libertaswealth.com.
All right, everybody. Today I am going off the rails. I'm going to tell you that right up front. I'm so frustrated with the financial and political news. Let me repeat that. I am so frustrated with two things right now: financial news and political news. Do I watch it? I watch the financial news, yes, but do I watch political news? No, not really. Well, occasionally at best, as in when I'm already full and I can't eat anymore, when I'm tired of getting stuff done around the house because I love doing that, when I've built 3 or 4 shelves and planters, when I've already cut my fingernails and toenails twice, then maybe I'll watch political news. Maybe then I'll watch political news. But my friends, please listen to me when I say you are being misled. Financial news and politics are in the business, or political news, I should say, they're in the business of scaring you half to death so that they can get good ratings, so that they can get paid, and paid well, by the way. And I'm sorry to admit, but I think they're doing a pretty good job. We've got to put a stop to it, though, because for a few of you, not all of you, but some of you, a growing number of people, one of the things I've noticed is that especially when people retire and they're not working all day, they have more time on their hands. Sometimes they tend to watch more TV. And in fact, the statistics prove that people watch more TV when they retire. And unfortunately, some of the TV they're watching is political news and financial news and things that are just not hurting you. I'm sorry, just not helping you. They're hurting you. So, you know, for a bunch of you out there, this news is misleading you. It's causing unnecessary stress. It's keeping you from having good, fun relationships with relatives, having good conversations, and it's keeping you inside. It's like a self-fulfilling prophecy. You can continue staring at the TV, your phone, or both. So today, I actually planned on recording a different podcast. That's a lie. I actually already recorded a different podcast. It was done, and I decided to record a different one today because this is bothering me so much. I wanted to put things into perspective right now, and hopefully I'm going to remove some of the stress from your life through a podcast, and I'm being serious. My goal today is to help you see through the chaos and hear through all the noise. So please, by all means, share this episode with your friends, coworkers, family. This is important for everyone. I mean, everyone needs to hear and see this stuff. But before we get started, I always have to have our little housekeeping items. If this is your first time listening or watching, thank you for joining us. My name's Adam Koch. I am president, portfolio manager, and senior financial advisor at Libertas Wealth Management Group in Columbus, Ohio. You can follow me on Twitter. I kind of go through spurts where I post a lot and then I don't post anything for a while. But I'm on Twitter at Adam Koch. That's Adam, ADAMKOOS, as in Sam. And of course, I'd be remiss if I didn't share. If you'd like to schedule an intro call to confidentially discuss your financial situation in more detail, or if you'd like to get a second opinion on your retirement plan and or investment portfolio, head over to our website at libertaswealth.com. You can click on the button that says click here to get started, and someone will reach out to get something on our calendar. Last but not least, all links, visuals, charts, other educational resources are always on our website. Today I do have some visuals. They're not crucial for those of you who are listening on iTunes or Spotify. If you want to head over to the YouTube page and check out, there's going to be maybe one chart that I'll show you that you could, maybe benefit from seeing. Otherwise, all we're looking at is magazine covers, pictures, visual aids, and things like that. So let's go ahead and get started here. I always start with a quote. I couldn't stop that trend today. And the quote today is from Baron Rothschild. And I'm not going to say the quote yet. I'm going to tell a story. There was a time way back in the 18th century. Baron Rothschild, he's over there. He's one of the richest people in the world at the time. You've got, Napoleon going to Waterloo to fight Wellington. And there was, Wellington was hugely outnumbered. And everyone thought, or I shouldn't say thought, but everyone knew there was no way that they were going to win the war. And through the help of, because we didn't have the internet back then, obviously, there was no app on Baron Rothschild's phone that was going to tell him what was going on in the stock market or who was winning the war. But through the help of homing pigeons, Baron Rothschild finds out who's going to win the war. And what he does is he goes to the London Stock Exchange and he sells everything he owns. And what happens? Everybody follows him. Everybody sells as well. And then what did he do? A few hours later, he turns around and he goes and buys everything up in sight after the market had already crashed. In a sense, he ended up making more money, I believe, to this day than anybody has ever made in the stock market in one day on an inflation-adjusted basis. And what he said when it was all over, he said, you buy when there's blood in the streets, even if it's your own. So the story here, I mean, that's an extreme example for, when in terms of what we're going to talk about today. The London Stock Exchange crash, the 2000, 2001, 2002 market crash with the World Trade Center attacks, the mortgage crisis, huge crash, right? Actually, I think it is to this day, with the exception of the Great Depression, it's still the biggest in history. We're not talking about those things. The things that I'm concerned about that people are watching on the news or hearing on the radio are things that are just distracting them from what really matters in life and what really matters in investing. And I'm going to go back in time here and we're going to go through a bunch of these things. And we're going to start with Y2K. You remember Y2K? So Time magazine has on the cover, it says, the end of the world, Y2K insanity, apocalypse now. Are computers going to melt down? Will society melt down? A guide to millennium madness. Now, obviously, this was the top of the market before the market actually did crash, but the market didn't crash because of Y2K. It had nothing to do with it. It had to do with the dot-com bubble. It had to do with, it was accelerated through the World Trade Center attacks. So, but Y2K was no big deal. But how much time did people spend worrying about it and maybe selling their investments because they were worried about it, or maybe they didn't invest their money, or they let their cash sit on the sidelines because they're like, oh, I don't want to invest my money because Y2K is coming. And that's the thing. Before I get into all these, honestly, what you're going to find is a trend. There's always something. There's always going to be a reason not to put your money to work. There's always going to be a reason not to plan for retirement. You can keep kicking that can down the road, but at the end of the day, there's always going to be something out there to distract you. And again, it goes all the way back to if you were running news companies, if you were running CNBC, if you were running MSNBC, CNN, Fox News, any of these things that people like to watch, I mean, are you going to put boring news on? No. Are you going to put good news on? No. Why would you put good news on the news? Who's going to watch good news? Nobody cares, right? If they put stuff in the news about how Y2K is not going to be a big deal, it'll be fine, go back outside and go for a walk, nobody would watch the news and their ratings wouldn't go up. But I digress. So let's keep going here. Here's the next one. Anybody remember the SARS outbreak in 2003? Obviously way before COVID. But how many of these outbreaks have we had? The SARS outbreak in Newsweek. The headline is, can it be stopped? The new age of epidemics. And people were terrified. They didn't want to invest their money then either. If we move forward in time, we have the swine flu pandemic. So SARS was 2003, swine flu was 2009, just a few years later. H1N1, what is it? It's the new type of influenza virus. The first case was reported in Mexico. The World Health Organization declared an outbreak as a pandemic. How does it spread? How do we protect ourselves? What's going to happen to the market? Are we going to have a global collapse? What happened? Think about it, people. What happened? Nothing happened. Now, I know that sometimes things do happen, but we can't spend our lives. We can't manage our money and manage our retirement savings and bank our financial future on always erring on the most conservative possible outcome, which is doing nothing. And what I mean by that is sometimes not making a decision is a decision. You have decided not to decide. And I think that's important to understand. Swine flu moves on to the Ebola outbreak. 2014, a few years later, we've got the Ebola outbreak. Again, I don't know why so many of these in the 2000s and 2010s were diseases or potential outbreaks, but that's what they were. And then from the 2014 Ebola outbreak, we have the Chinese stock market crash. We have in Shanghai, the index goes from 5166 down to 3709 in less than a month. In other words, the market in China went down 25%, lost a quarter of its value in less than a month. And people are freaking out. Is it going to happen here? Is it going to spread throughout the world? Did it? It didn't. It just didn't happen. It did not spread throughout the world. It didn't come to the U.S. Now, granted, during that time period in 2015 and 2016, the market did go through a very prolonged period where in the U.S. anyway, the market was down about 12.6% in 2015. It rebounded slightly. It went down another 14.6%, I believe it was. Then it rebounded again. and then it went down slightly. I believe it was about 4% decline was all over the course of the summer months in 2016 before the election took place, after which the market took off from there and took off in a good way. So, but again, this was another quote unquote crisis where things didn't end up nearly as bad as people thought it would. And there are so many people back then who in 2015 were saying, you know what, I'm going to hold off on investing my money. I'm going to wait because this China stock market exchange, I don't know what's going to happen here. So I'm going to sit tight. I'm going to hold off. Or I'm going to sell. That's the word. That's even worse. I'm going to sell my investments because of this, because there's always a reason to sell, right? By the way, this is probably a good time to stop. We knew somebody once who sold all of their investments in 2009, almost at the market bottom. So almost at the bottom. This is a true story. This isn't, oh, I heard this happened or I read a story about it. This happened to someone I know. Unfortunately, we don't work with them. I wish we did. I wish we could help them, but I don't know if anybody can help them, honestly. But this particular couple sold all of their investments in 2009, and when we met them in 2018, they had not invested a dime. They were sitting in cash the entire decade, and even when they decided to put some money to work, it was 1/3 of their money. And after not even a year, not even 12 months, it freaked them out so much being in the market that they had to sell again, and they just got out of the market. They actually made money, by the way. They actually made, I believe it was just like 8% or something like that in under a year. But they sold, got out of the market again, and I have no idea what they're doing now. But it breaks my heart. I just don't understand. I guess maybe it's because I'm such a robot when it comes to this stuff. But I guess the reason I'm doing this podcast is I'd like for you to teach you how to be a robot too, I guess, or be more robotic. I don't want you to be robots, literally. But people will say, I don't want to buy now. I don't want to invest my money now. Things are crazy out there. Look at the politics that are going on. And I'm only saying this. I'm not picking political sides here. I'm just saying Biden's in office right now, so that's what I'm hearing. When it was 2016 to 2020, it was all about Trump. All I could hear is Trump stuff all the time. Now I'm hearing, well, what's Biden going to do? Oh, the market's going to collapse. I can't trust what Biden's going to do. Biden's not running the country, just like Trump wasn't running the country. There are a lot of other people that are running our country. It's not the president of the United States that makes all the calls. I can guarantee you that. That all being said, let's just say you say, oh, I don't want to buy right now because things are just kind of crazy and I don't know what Biden's going to do. I'm going to wait for things to get better first. Well, when you say you're waiting for things to get better, what that means is you're waiting for prices to get higher. It'd be like going to the store one day and saying, oh my God, I've been waiting to buy these shoes. I really need these shoes, actually, and they're so cheap. Something's got to be wrong with them. I think I'm going to wait for the prices to get higher before I buy these shoes. So you start checking weekly for the prices to go up before you buy the shoes. And I mean, that's what happens with the stock market. I'm in the only business in the world where when prices go down, people want their money back. And when prices go up, it's like people throw money at you. It's the same one. But you know what happens when prices go up? I just kind of said it. I gave the punchline away. Prices go up. And people say, I don't want to buy here. The market's at all-time highs. I'm going to wait for a pullback. I'm going to wait for the market to go down. Then I'm going to buy. Then I'm going to invest my money. But then the market goes down. And what do they say? They say, well, I'm going to wait for things to get better. You're going to wait for prices to get higher. Remember what I said earlier. Not making a decision is a decision. And it's not. I just got a book, Ned Davis, Making Money. I think the title is Being Right or Making Money, and that's such a great title because I think so many times what happens is people, our egos get in the way. We want to be right. We don't want to buy at the wrong time, and if we buy and we're wrong, then that just hurts our egos so much that if we would have waited, we could have perfectly timed it. If we just would have waited, then, maybe prices would have gone lower. But you know what? The further you scan out, the further you look back at the market, not in terms of what's happened this past week or this past month, but then if you look forward 1 year, if you look forward 3 years, 5 years, 10 years, the further out you look, the higher the probability things are going to be just fine. And by the way, 5 years from now, nobody's going to care about the debt ceiling, which, by the way, they just increased for the 103rd time. That was big news. What's going to happen? What are they going to do? They're going to raise it. That's what they're going to do. Like, why are we worried about this stuff? And I think I've got something on that here in a second. So let me shut up and move on because I always talk too much. But here's the next one, Brexit. Remember Brexit? That was a big deal. Summer, I can't remember what year it was. I think it was summer of 2010, maybe? No. It was later than that. But anyway, it doesn't matter. Point being that, Brexit was another thing that was, there was going to be this contagion around the market because, Britain was leaving, and there's all these headlines where it's going to be, there's going to be a deal, then there's not going to be a deal. And then, what's going to happen to the other countries in the euro? But again, it was a blip on the radar. When you try to find, I challenge you to go back in time on a stock chart and try to find on the Dow or the S&P 500 or the NASDAQ, try to find Brexit. Try to circle it. I bet you can't find it without literally Googling when it happened and then going and circling. And actually, you know what? That might be a good exercise for everybody. First try to find Brexit on a chart, because I didn't tell you what year it was. I can't even remember. And then when you can't find it, because you won't, then go back, Google the date, and then circle it and look how small it was and how little it matters. Because that's what most things are. They're small, they're little, and they don't matter. Here's the next one, the 2010 flash crash. I remember this one like it was yesterday, because it was, I literally stopped everything I was doing this day because, it didn't make any sense. The Dow was going down so fast, and nobody had any clue what was going on. And what was essentially happening here was you've got all these what are called open orders on the market. So when you sell an investment, I'll just say when a lot of investments start being sold, there's prices below the current market price where there's open orders to sell at that price. So what happens, you get this cascade effect. Whereas the market hits a certain level, we'll just say 100. I'm make an easy number up. So, I'm looking at the chart here. So the market hits 10,600 on the Dow, and then some sells kick in. That selling pressure drives price lower. All of a sudden at 10,500, there's more sell orders. Those kick in. And all of a sudden you got even more sell orders kicking. That pushes price down even faster. You get this huge exponential cascade where all these sell orders are kicking in, essentially, by the way, locking your sell prices in at low prices. And then when all the sell orders are exhausted, when there's no more sellers or no more open sell orders, limit orders, it stops. All of a sudden you get the vultures come in, which is not a bad thing. This is smart money. They're coming in and saying, okay, things have stabilized. Time to start buying. It's time to start taking advantage of this. But this is, I don't want to call it gambling. That's not fair. But this is, I don't want to send the wrong message, I guess, is what I'm saying. I don't want to give you the idea that, wait for a flash crash to happen, then buy. There's been 2 flash crashes in my career. That's it. And I don't know. I don't say it'll never happen again. The likelihood is small that it'll happen again because they keep putting measures in place to keep it from happening again. But yes, would it have been cool to buy at that point? Of course it would have been. You'd have made an extra 10% in one day, potentially. But that's not what we should be sitting around waiting for. We shouldn't. And so again, that's why I'm saying I don't want to give the wrong message across. Flash crash happened. People start freaking out like there's something huge coming. It's gonna get worse. And that's not what happened. It was a one-day thing that was very quickly over with. And again, unlike Brexit, I bet you can probably find the flash crash, especially since if you're looking at the screen here on YouTube, you can see it was in 2010. It's pretty easy to see. But look at how fast it was over with. And if you erased that time, it really wouldn't have mattered then. It's almost like if you take the 22 days of COVID, if you wipe them out, it looks like there was no volatility at all. And it's almost like market wasn't volatile, market was easy. No big deal. COVID went down 34%, 22 days. Take that out, looks like a nice market, but it wasn't, was it? Next one we have here is the Greek debt crisis. If you ever heard about the pigs, Portugal, Italy, Greece, Spain. Greece was kind of the worst of the 4 countries. They had all this debt. Again, and this just talks about Greece, but you can look and see how big the debt was or how big of a problem it was. You can compare it to, Bill Gates' estimated net worth, $54 billion back then. Facebook's value in 2011, $61 billion. The funds needed to recapitalize European banks, $200 billion. The cost of recovery for after the tsunami in Japan, $229 billion. If you add up the net worth of the 10 richest people in the world in 2011, $301 billion. The Greek debt in October of 2011, $357 billion. That's a lot of debt. Is it something to be concerned about? Well, yeah, for sure, especially if you're in Greece, especially if you're a politician in Greece or somebody in charge of finances in Greece. But is it a problem for people in the U.S.? It was something to talk about. It was something to get scared about. It was something for financial news and political news to freak people out about and get us scared and make us make stupid decisions or no decision about our money. It made us. It was just another blip on the radar, another reason to distract people from what really matters. And I'm going to keep going here. I'm going to try and speed up. But this is the U.S. debt downgrade in 2011. Here we got Time Magazine, a picture of George Washington with a black eye. The S&P Standard & Poor's downgrades U.S. debt in summer of 2011. A market goes down 20% in a matter of days, weeks. And it's, again, where it's going to be this ridiculously huge deal. And people are, freaking out again about their money. And it ended up just being a blip on the radar. Now, was there action that should have been taken? Yes. Did we take action at our office? Of course we took action at our office. But that's our job. That's what we do. Our job is to take the burden of stress off our clients' shoulders, watch this stuff all day, every week, every month, and take the necessary precautions and actions that are required, depending on the client in question, their age, their net worth, their income, investment objective, risk tolerance, all those things, to make sure that we're doing the right thing for their money long term, keeping the short term in keeping the short term in perspective with the long term, of course. And yes, we made some changes in our portfolios, some pretty dramatic changes in our portfolios in 2011 to protect against a potential huge drop. But it ended up not being that big of a deal in the end. If we move forward, remember this one? I almost forgot about this one. The fiscal cliff. Oh my God. If I had a nickel for every time I heard a question through email, phone, if I looked at articles about the fiscal cliff in 2012 and how we were driving toward the fiscal cliff and what were we going to do? Oh my God. And in the end, nothing. It was not a big deal. And that brings me forward. This is one of my favorites today because we just raised the debt ceiling for the 103rd time, like I just said, in the U.S. history. Is in 2014, there was all this talk about the debt ceiling, and what happened? They didn't raise it. And what happened? They closed national parks. I know. It was rough. I just think back to all those days when I just couldn't go to the park, Yeah, it was stressful. But then they reopened the parks, and then they raised the debt ceiling, and then all the time that the government was shut down, they paid them for the time that it was shut down, and the government reopened, and we started talking about something else. And it was over. That's it. What we start talking about? Well, we started talking about the biggest drop in the Dow in history. And the Dow was down over 1,100 points in one day. Oh my God, what are we going to do? And people were freaked out again, and it was another reason not to invest our money. It was another reason to think about selling. It was another reason to add stress to our lives and not enjoy the fact that we're living, breathing, pieces of biology here on this earth that can talk to each other and have fun and read books and ride bikes and go to plays and musicals and watch sports and participate in sports. But instead, we're watching the news. Instead, we're watching the news and we're getting freaked out about stuff that in 5 years, let alone 10 years, 5 days, isn't going to matter anymore. Excuse my passion here, but man, global trade war in 2019, this is Trump. What's going to happen? All these tariffs we're putting on China, all these things we're doing to level the playing field, our GDP is going to collapse. We're talking about the all-out collapse of the U.S. dollar potentially. It's going to be bad. Here we are, 2023. Who's talking about global trade? Now, some people are talking about our relationship with China. Sure. Is that something to be concerned about? Maybe, yeah, maybe. But are we talking about the global trade war anymore? No, we're not. We've got a new administration in there. Now we're talking about something else, complaining about something else, worrying about something else, stressing about something else, when we should be spending time with our families, our friends, our kids, grandkids, and enjoying that time, playing Monopoly for 4 hours, instead of watching, Fox or MSNBC for 4 hours. That's for sure. Here's another one. The yield curve inverts. Oh my God. Well, when the yield curve inverts, that means the probability of recession goes up. Oh yeah, it does. It does. That doesn't mean the probability of recession goes up. Well, what should we do? Should we sell all of our investments? Should we, wait to invest and try to find the perfect time? No, we shouldn't. Again, I'll calm down here for a second. If the market just went up in a straight line, even if that was 3% per year, something modest, kept up with inflation long term, I wouldn't have a job. Now, I'm here complaining about this news and how tough it makes it on people, investors. And it's why we have a job. Not the only reason, but it's one of the big reasons we have a job. And it's one of the big reasons why, we spend so much time on portfolio management and retirement planning and financial planning and tax planning here at our office. But that's why we have a job. And I can only hope that when someone hires us or someone like us, doesn't have to be us, if you have a financial professional that you work with, financial advisory firm, that you like them, you trust them, then go read a book. Don't watch the political and financial news. It's not going to help. When's the best time to open your investment statements? When the market's going up or when it's going down? I'm not even going to answer that one. If you like being stressed, open your statements when it's down. Because if you're stressed about it being down and you open up and it's down, well, you're going to be more stressed. Does the market go up and go down? J.P. Morgan, I remember when he was once asked, what's the market going to do? What's your prediction of what the market's going to do? And his answer was, it's going to fluctuate. And that's what the market does. It fluctuates. It goes up, it goes down. On average, it goes up every 3 out of 4 years on average, which means it has an upward bias. Do we need to protect ourselves against catastrophic drops? Yes, we do, in my opinion. I very strongly agree with that opinion that we need to protect ourselves against catastrophic drops in the market. But do we protect ourselves by watching political news? No, because if that was our way we protected ourselves, then we would never invest our money, because there'd be a reason daily not to invest our money, to put it under our mattress. Think about that. I mean, some of you listening or watching this, you may have said that before. Oh my God, I just want to put it on my mattress with what's going on in the world today. Well, that's why I don't watch political news, and that's why instead I'm looking at relative strength and volume and momentum and charts and trend. That's what matters. At the end of the day, I was just telling up in Cleveland speaking last night at an economic summit, and I was telling the crowd up there, a bunch of business owners, I said, it doesn't matter if Apple has the best quarter they've ever had in terms of selling Apple Watches. So if they sell the most Apple Watches, the highest quantity of Apple Watches they've ever sold in a quarter, the stock will only go up if people buy the stock. If nobody buys a single share of Apple, and nobody sells a single share of Apple, after that quarter, the stock doesn't go anywhere. It takes people buying and or selling the stock, and then the pressure or enthusiasm pushing the stock up or down from there. And it's always people hitting the buy and the sell button. When people buy, if there's more buying enthusiasm than selling enthusiasm, price must rise. If there's more selling pressure than buying pressure, price must fall. That's it. I don't boil it down to saying it's that easy. It's not easy, but it's that simple. It's not, the best time to know if Apple's going to go up is to, check and see what whether the executives are doing insider buying or not this past quarter, and to see what the earnings per share are compared to the S&P, and then to see how many iPhones they've sold versus how many Apple Watches, and none of that's going to work. It's not. I mean, you can make a good story out of it, but that's about it. You'd be better off using ChatGPT and AI. Anyway, I digress again. Here's another one. I forgot about this one too, by the way. The repo market. So when the emergency Fed injection of money into the repo market, that was a big deal. That was another reason why we shouldn't invest our money, or why we should be worried about our money. This one, I don't even have to spend any time on it. The COVID-19 pandemic, right? We all know about coronavirus. It's still crazy to me. It's already been 3 years. Feels like a time warp, actually, that this happened 3 years ago. We were still stuck at home right now. But obviously that was a big deal, but it happened fast and it was over fast. And then again, I've already talked about this a couple times today, but the debt ceiling crisis. I couldn't believe I was getting phone calls like this. And maybe I'm just getting old. I don't know. I've been doing this for 22 years, and I'm only 44 years of age. And I was just surprised, honestly, when I started getting emails and phone calls saying, hey, what do you think is going to happen with the debt ceiling? Because immediately my first thought is, well, the debt ceiling has already been raised twice under the Biden administration. I believe it was twice. I think the Trump administration raised it 2 or 3 times. So what are they going to do? They're going to raise it again. I mean, why are we freaking out about this? But that's what was happening. Now, for those of you on YouTube, I want you to look at your screen here. You can hit pause. Honestly, hit pause and just stare at this. Look at this, goes back to 2009, and it's not updated through 2023. But if you're listening on iTunes or Spotify, come back to the YouTube page. I'll put a note, or I'll ask my producer to put a note in the speaker notes or the speaking notes to to show you where this chart is. But this chart basically shows you from 2009 to 2020 all kinds of reasons why you should not have invested your money, and even more reasons why you should have just sold your investments and gone to cash, put it under your mattress. And if you'll just look at this stuff and you realize that there's always, and this is just some of them, by the way, these aren't all the reasons. 663,000 jobs lost in March of 2009. Top 5 ever losses, monthly losses ever. Chrysler, General Motors file for bankruptcy. BP oil spill. Flash crash we talked about. The most powerful most powerful earthquake that ever hit in 2011. Stocks fall 20% after U.S. Treasury downgrade. We talked about that. The sovereign debt crisis in Europe. Dow having only 5 positive days in a month for the first time since 1968. Do you think the financial news didn't get a hold of that? You think they didn't go jump on that statistic and start spewing it for 24 hours so that just in case the Dow had a good day? God. Anyway, oh my God. All right. I'm gonna share some good news. So what about the good news? This is just today. This is just good news that it took me 10 minutes to find this. First of all, S&P 500 has been hovering and doing above a golden cross. So it's been hovering above its February highs and closing in on summer highs. I typed this all wrong, by the way, for those of you watching on YouTube. Talk about a typo cluster. So S&P has crossed above its February highs. We got higher highs, higher lows. That's good. That's an uptrend. And it's closing in on summer highs from last year. That's good. The stock market breadth, meaning participation of smaller companies, mid-sized companies, is improving as small caps rise on high volume buying this week. New 6-month and 52-week lows collapse as stocks pop to start the month of June. That's good. Apple, talked about Apple a couple times today. Apple on the verge of breaking out to new all-time highs. Last I checked, new all-time highs are not bad. Markets are making a bet that inflation is finally starting to ease. I could do a whole podcast on that, by the way. Used car prices are falling as sales soften as interest rates rise. So the pessimist looks at that and goes, oh yeah, okay, well, prices are falling in the used car market, but that's because interest rates are going up. Well, you know what? I got one for you. Bonds looking pretty attractive again as interest rates have risen. So just because there's bad things happening in the market doesn't mean it can't help your portfolio in another way. Oil prices rise, buy oil. Yeah, does it cost more at the gas tank to fill up your car? Sure. Have it in your portfolio. Own commodities. Was it 2000 late 21 through mid 22? We owned a lot of commodities and oil in our portfolios. It's tough to have to fill up your tank for $100. That's no fun. But you can hedge some of those losses at the gas pumps by owning the commodity that's going up, that's causing the gas pumps to go up in price in your portfolio. International stocks come into focus. The U.S. dollar struggles. So people, again, the pessimists say, well, yeah, U.S. dollar struggling. Is it going to collapse? Like people have been talking about the U.S. dollar collapsing forever. My whole career, I can't count how many times I've heard U.S. dollar is going to collapse. In fact, my favorite, I can't remember what year it was anymore at this point. Might have been 2017. Somebody sent me this email and it's like, hey, there's this article, and it was I probably shouldn't say what company put the article out. I'll probably get sued. But the article was basically saying a congressional bill has been signed that has been put in place, and if you watch this hour-long video that you can't stop, pause, or rewind, by the way, and after you watch that video, if you read this 20,000-page article, and then after the article's done, if you sign up here to be a member of my market letter, that you're going to get a newsletter every week, then you come to find out that this congressional bill is going to cause the U.S. dollar to collapse in, I believe it was like July 1st of 2017 or something like that. Don't quote me on the year. You know what happened? Again, I don't know what year it was, but the dollar went up faster and more than it ever had in such a short time in history. That's what actually happened. Meanwhile, there's this And so it's not even just news. It's people selling stuff, newsletters out there to just get subscribers that, aren't even giving you good information and good advice. But my point in mentioning that is that the U.S. dollar has done extremely well until last September. If you go back and you look at some of our podcasts and screencasts in mid to late 2022, you'll see that I put some charts out there about how magazine covers have a tendency to predict peaks and troughs. Well, there was a couple magazines out there, Bloomberg Business being one of them, where literally at the top of the gold market, the U.S. dollar market, not the gold market, but at the top of the U.S. dollar chart, they come out with a magazine cover that says, "Can't stop, won't stop." Like basically saying the dollar's just going to keep going to the moon. It literally peaked that month, and we haven't seen those prices since last year. Right now, the dollar's been going down. But you know what? That's good for international investments. That's good for private equity. That's good for people buying companies overseas if they're here in the U.S. But it's also good for the average Joe investor who has a portfolio of investments that since 2009, because the U.S. market has been leading everything else in the world, that now all of a sudden, because the U.S. dollar is going down, the dollar goes down, international stocks start doing better just through exchange rate. So all of a sudden now we can find different places around the world to buy investments that are doing better overseas than they are doing here on U.S. soil. And just for fun, here's some good news. Molson Coors, people are still drinking beer, even though Bud Light's down, or not Bud Light, but Anheuser-Busch is down 19%. Molson Coors has been a beneficiary of that decline, going up 22% in the same amount of time. So there's always something good out there. And here's a good statistic. This is a good one to end on. Golden crosses. Like I said, I had a typo in the last slide here, but a death cross, and you got to love that name, by the way. A death cross is when the 50-day moving average or the 50-day trend line of the market crosses below the 200-day trend line or moving average. A golden cross is when the 50-day moving average crosses back above the 200-day moving average, essentially indicating a long-term uptrend. It's one of the many ways to define an uptrend, and there's lots of them. There's lots of ways to skin a cat, as the saying goes. Going back to 1950, there have been 16 times when the 50-day moving average has crossed above the 200-day moving average. Very simple metric here, very simple technical crossover. And of those 16 times, the market has been up 15 out of 16 times, 93.8% win rate. So only once was the market down 12 months later since 1950. The average return 15.7% 1 year later, the median 16%. So I'll say that one more time. Whenever there has been a golden cross, the 50-day moving average crossing above the 200-day moving average, there's only been one time since 1950 out of 16 times that the market's been down a year later. That's a almost 94% win rate. And the average return, 15.7% a year later, median 16%. And on the end of January, beginning of February, I believe it was January 30th, I think it was, maybe 31st, we had a golden cross on the S&P 500. And that's where I'm getting these statistics. Actually, shout out to Ryan Dietrich for putting this table together. I totally stole it from you. But anyway, that's what we're looking at. I could give you no shortage, unfortunately, of bad news, but I'm not going to do that. All I did today was deliver you a bunch of bad news you've already seen before to put it in perspective and help you realize how little it matters. And then from there, what I hoped you learned from this today is that you learned that if you can't do it yourself, if you can, by the way, I always say you can manage your own money. You can manage your own stock portfolio. You can manage your own retirement planning. You just have to have two things. A, you have to have the interest, and B, you have to have the time. Even if people have the interest, most people don't have the time. But if you have the time and interest, you can do it yourself. A lot of times what happens, people aren't interested, so they just won't spend the time on it. Or again, like I just said, they are interested, but they don't have the time because they're busy doing what they do for a living, making money for the family, spending time with their family and friends, and they just don't have time to look at the stock market every day. So that's why people like us have jobs, financial advisory firms, financial planning firms. That's why we are trusted with people's hard-earned savings, is because that's what we do all day as we stare at this stuff. So if you'd like to get a second opinion on your portfolio, your retirement plan, your financial plan, please know that's something that we do multiple times a week for several people, and we'd be happy to help out. And the way our process works, by the way, If you go to our website at libertaswealth.com, whether you use the contact form, the chat form, or if you go through the click here to get started button and answer a bunch of questions, what's going to happen is at the end of the day, you'll end up getting an intro call set up with me. There's no cost for the call. I'll get to know you a little bit better. We'll get to know kind of what your situation is, what you look like right now, and then I'll explain our process to you and how that process works, answer any questions you have, and at the end of the day, if we decide we want to go through that process, great, and if not, we part as friends, and that's it, so there's no cost for that. So anyway, this is probably a good place to stop at this point. So feel free to share this episode with your friends and family. And if you, if you think you learned something, by all means, again, everybody needs to be learning about this stuff because there are so many distractions out there and so many things that keep us from doing the right thing when it comes to our money. So yeah, please pass it around and subscribe on iTunes, YouTube, Spotify. That way you get the notifications whenever these things are released. And remember, you can actually go to our website at libertaswealth.com to not only get these updates, but you're also going to get access to our screencasts that we do, videos, articles that we write and send out to our clients, and they'll get delivered as soon as they're released. But instead of just being a notification, it'll be delivered directly to your inbox. Be sure to follow us on Facebook at facebook.com/LibertasWealth. I'm also on Twitter at Adam Koch, that's Adam Koos, as well as Instagram at Adam D Koch, that's Adam DKOOS. As I always say, there's thousands of podcasts out there, and you chose to give hours a listen today. So thank you so much for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koch. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.